Hey, good morning, traders and investors. Todd Gordon here of TradingAnalysis.com as well as Ascent Wealth Partners. Nice to be back with you guys. I'm kind of watching from the sidelines the Trading Analysis team doing such a wonderful job with the public outreach, both as I said on the public side as well as the member side. So all's well. Here, good morning to the team. Alex, Terry, Bennett, how you guys doing?
Good morning, Todd. Looks like your camera froze on us.
Oh, did it really? Oh, okay, let me see if I can.
You should just be able to refresh really quick, and that should...
Refresh. Let me just try this real quick. Let me just pop them out. And this is
good morning, everybody.
Yeah, good morning, YouTube. Good morning, traders. Hope everybody's doing well today. It's the first month of the second quarter. It's April Fool's Day, 2000.
I think it's canceled. It's canceled.
It is. It is canceled with everything that's going on, right? My gosh. But
Bennett, why don't you jump in? Let me see if I can get this camera situation straight.
Yeah, no worries. So, good morning, guys. Let me just go ahead and bring over the good old HYPOTHETICAL platform. Let me just start it off really quickly. Let's touch base with crude oil. We discussed this last week, and we highlighted the fact that although we felt a corrective move back to the upside was a potential, we didn't feel the near-term low was in. And we're viewing this in a couple of different ways. If you look at this on the daily, we had a nice retracement here in orange primary degree wave 4 to a 38% retracement of wave 3, which is very appropriate. If it gets you off the daily, get you down to like a 195 chart, there's actually a couple of ways we could look at this. You could actually look at this as orange 3 having yet to complete, with this being 1, 2, 3, and 4 of orange 3, and we're in some sort of ending contracting diagonal here with this overlap for blue 5 of 3. But regardless, the higher degree implications still stand, that we are expecting this 5-wave move once we come to completion, perhaps even to the lower end of this trend channel, to give us some sort of a retracement. So it looks like we've got Todd back in the mix. What's happening, sir? I'm going to bring over the S&P window. How have you been? We haven't seen you in a couple of weeks.
Yeah, thanks. I'm just listening. You guys are doing again such a good job. It's really a scary time for quite obvious reasons, but it's also a pretty awesome time to see trade analysis really do so well without me. So thank you. You guys just had a really nice month. That's just a little team, the company did very well in March. Obviously, we short-term trading businesses are. I would say correlated to volatility, and that's something I used to do as a trader. When I used to trade for a hedge fund, is actually would take my P&L and overlay it on the VIX, and there was a pretty high degree of correlation. So, but with that said, I think it was a tough volatility period to trade. As I was watching, what everyone, not just you guys, what everyone was doing, I think it was sort of a challenging trading period. I think you showed really good discipline in terms of sort of not chasing when it was not a good idea to chase. So that's fine. On the wealth management side, we're good. It's actually kind of a quiet period right now. I've got clients who've come on board and we're just sitting on cash. Right now, we've begun to lightly allocate some stock, their intended stock exposure into the market. Certainly not going all in by any means. We've been watching this sort of recovery back. Is this a dead cat bounce? Is this a way for a correction? I'm going to be very tuned into what you're saying, and I'm watching there to see what the answer to that is. And the futures this morning certainly indicate that's the case. So all's well. It's just a new, unbelievable world we live in. I think. I guess I'm speaking more to you three guys. We're pretty well advanced on the technology side, which, the rest of corporate America is quickly having to get there. And you're seeing, some certain stocks that are responding besides the obvious ones. Zoom, no surprise there. I'm sure Terry's going to talk about it. Don't want to steal your thunder. Citrix, which owns the software that we're going to be using to screen share. DocuSign is another one, where that's a company that sends you your contracts on email and you can just click and sign. That stock just broke out to new highs. Netflix continues to do very well. I think Amazon, I just did a CNBC trade here yesterday. Amazon's well positioned because people are still ordering packages, despite having to. I guess how are you guys treating packages in your house? I've heard you got to leave them outside for 3 days. And the coronavirus, COVID-19 can live on a package for 3 days. Then you're safe to bring into your house, or you just have to wipe them down. What are you guys doing with that?
I've actually been letting the packages
I bring
sit
it in,
out.
open it up, and then I go wash my hands. I mean, no big deal, right? So.
What I thought was interesting is when they first talked about the fact that coronavirus can live on the surface of cardboard, and then they came out and were talking about Amazon workers at certain packaging facilities possibly testing positive. So, it certainly spooks some people. If it's something that's, like a non-perishable, and I don't mind letting it sit out, I'll let it sit out, 24 hours or so. But kind of like Terry said, I'll open it outside and just try to clean it up and take it inside, but at the same time limiting the number of deliveries.
Yeah,
Leave
absolutely.
them outside too long, those packages grow legs,
But I don't think you guys, it seems to be, Texas I heard is a big state, and I don't think you guys, have the concentration. New York's a big state too, but you guys just don't have the number of cases that New York does. That's fairly accurate. It's just not the level of panic that we're seeing here in New York.
Yeah, we've got around 40 cases in the county that I live in. I'm in a county, let's say 30 to 60 minutes outside of Austin. Austin has a couple hundred cases, but yeah, there's 40 here in a town of like 60,000, I think it is. So
that's unbelievably low. That's amazing. We're upstate New York, so it's different. But obviously New York is the hotbed right now, and it's just basically, I think there's a high degree of correlation to very tightly congested areas. We're upstate, we're fine. People are staying out of each other's way. I'm still coming to the trading analysis office here. It's just me right now, so we're fine. All's well. And then back to my last couple points on Amazon. People continuing to shop online. And then web services. Don't forget, Amazon is not just a shipping company, but the AWS is doing extremely well. Their cloud services, which clients happen to be Netflix, happen to be Slack, and a few other major kind of at-home work economy companies that are booming in this sort of environment. So Amazon just hasn't given up anything. Amazon and Netflix of the FANG have acted well. I just keep going back. I'm impressed how technology has just remained resilient in this right here, which would lead you to believe that it should show our performance on the back half of this thing. Look at NVIDIA. I think NVIDIA is like $30 off the all-time high, and it's a $280 stock or whatever. Unbelievable. Intel's a holding in our portfolio at Ascent. Amazon's a holding. Chips are doing well. We've allocated capital to the Qs. Microsoft acts well. I think Apple's a little stuck in the mud here, but I expect it to come back. So, to be honest with you guys, I'm watching you guys do fine work in trading analysis. I'm kind of laying low on the asset management side because I'm not seeing a big rush to move into equity allocation. Yields on fixed income and corporate debt are obviously not very favorable in here, and certainly U.S. Treasuries. So I'm just kind of laying low. To be honest with you, I'm spending time with the family. I kind of look at it as a gift, and I'm sure a lot of you guys do too. Like, I got twin boys who are 6 and a baby girl's a year and a half, and I'm getting to spend quality time with them that I'll probably never be able to have again. They grow up, and Terry's at that phase where they're growing up, and Alex is too, where they're starting to leave the house. And I don't know, I'm just trying to take advantage of this sort of unique, highly turbulent time to spend time with the family. And it's been pretty nice because, again, I don't think we're going to have this opportunity again ever. So it's everything that's going on with me.
Yeah, very good. No, you make an excellent point, right? Like, let's make good out of a bad situation and spend some time with the family. And like you said, they're at the years that, you know, the more time you can spend with them, the more memories you're going to make. So that's it's always a good thing.
I don't think anybody is ever going to forget this period of 2, 3, fill in the blank amount of months that this thing unfolds. I don't think anybody's ever going to forget this.
I saw this joke that was going around, and it said, "Hey, could we uninstall and reinstall this version of 2020? It has a virus."
That's pretty good.
I thought it was pretty good. But
yeah, this version of 2020 is corrupt. Control Alt Delete.
Reboot. So, anyways, guys, yeah, thanks for being here and tuning in with us. We've missed Todd. Glad he's back, but.
You guys are doing a hell of a job. You're doing fine.
I appreciate it. Yeah, we've been having some fun. The past 3 out of the 4 trades we've taken have been almost 200% returns. So we've been taking advantage of this market in the times we see appropriate. So looking forward to seeing where this ultimately takes us, and just, you know, glad to, heck, we're trading a 50 handle in the VIX. What a time to be alive, right?
Unbelievable. And the market is 20% from the lows, and we're still at a 50 VIX.
Yeah. So guys, last week we had Alan Lax on as a guest. We had a lot of fun there. I was actually communicating with him. We were talking, got an email from him yesterday, and we wanted to go over this chart here in the S&P that I'm bringing to you guys. And the discussion that he wanted to have, and I think is very valid, from an ElliottWave standpoint, is to dissect the highest degree of trend and determine if, in fact, the move here into January of 2020 can be counted as a 5-wave move post-December 2018 low. And obviously, if that is the case, the implications here are a little bit different. So let's just take a step back. This will take just a few minutes here. We're going to go back to the credit crisis lows here in 2009. And if you're new to the ElliottWave theory, you might look at this and have a tendency to label this as 1, down in 2, this as a smaller degree 1, 2, so forth and so on. The issue becomes that this is a larger net percent retracement than this correction here, which would create a degree violation, which is why we think it's most appropriate to view this period here as a wave 2 flat. Additionally, I'll show you here in just a minute. Let me just drop these in some random places. Additionally, this structure here looks to me, even on the weekly, as a 7-swing corrective structure. So it would make sense that we're viewing that as a B wave. So essentially AB, extended 5-wave move in C. And also you can see this nice 5-wave move off the B wave high. We have some pretty decent fib going on here with relationship between C and A. So from there, can you view cycle degree wave 3 completion, cycle degree wave 4 completion, and a cycle degree 5th wave completion? The only way that we feel it would be appropriate to do so is this. You wouldn't, for instance, put your wave 3 cycle top here, January 2018, put the December 2018 low as the cycle degree wave 4, because then you're left with, and this is exactly what Alan pointed out, he's like, hey, you might want to bring this up with the viewers for those that may be looking at that as a 5-wave move. So I think it's pretty clear that what you see here is a 3-wave structure. I would not ever really entertain looking at this as, for instance, perhaps like a 1, 2, 3, long triangle, and 4. Obviously, there are times in which we see an extended 4th wave relative to time elapse in wave 2, but this would give you a move that is just so disproportional and so far from, you know, the right look that we desire out of our ElliottWave counts and as the guideline states. So the only way to actually look at that as a cycle degree 5th wave top is the count which Todd proposed as a possibility last year, which worked fantastic out of the NASDAQ and Apple. And essentially what that is a complex combination starting off the September 2018 high. So that 2940 spot 91 all-time high at the time that we had that massive move lower. So This is a pretty straightforward three-wave correction.
Take that B wave. There you go. Move it, or X wave. One swing to the left. Yeah.
And then
it still may be valid. And just tell me to shut up, Bennett, if
go
if
ahead.
you're about to make the point. It's still valid, but anyone, viewers of the show, I mean, write it in. Why is this not likely from the ElliottWave guideline? Right look, as Bennett just mentioned, like, why is that not likely, not probable? I wouldn't say it's incorrect, but it's improbable.
I know.
Go ahead, you can tell it.
No, I was going to say, I know we've got some solid viewers out there. I know they're gonna get this.
So I would pose the question then: do you guys think that's possible? I'll get to the comments here. Do you guys think that's possible? Is anybody using that as your primary account? So go ahead, Bennett, and
you're good.
I'll just kind of monitor answers here.
So what this leaves us with is a wave 5 that is just so disproportional to wave 1. It really doesn't fall into any of the degree fib levels, not necessarily the higher degree fib implications, but when looking at this 5-wave structure off the credit crisis lows, we have a nice extended third wave. This also gives us kind of an even unusual fourth wave. So there's a couple of issues here. I've also seen people not even label this as a complex and just look at this as a straight triangle, which it leaves you with a really short and abrupt final 3-wave move here in C, D, and E. Regardless, the implications are the same for wave 5. So that discussion
and plus it's not valid in the NASDAQ.
Yep. So, looking at that as a cycle degree wave 5 completion, I don't see as the operative count. Did we get any people responding there who might be looking at that as their primary?
BB said wave 5 is way too short, and that's absolutely correct. Yukumwe, sorry for pronunciation, does not look right. With wave 3 extended, could it make sense? Tom Davis says, that's interesting, Tom. Generally, if wave 3 is extended, the relationship is net percent distance traveled in 1 is equal to 5. And our point is 5 would be probably, less than half or a third of net percent distance traveled in 1.
Yep.
So yeah, guys are saying too short. Yep. And Mike McCrae, funny. Saratoga guy says Todd who? That's a good one. I like it. Actually, I met him. Client, customer, friend. He is in Saratoga. We went and had lunch, and it was nice. So what's up, Mike? So now wait a minute. No, I'm not going to take us off track. No, that's fine. All right, keep going. Keep going about it.
No, I don't mind. We're here to have fun. So where does that leave us, right? Where does that leave us from an ElliottWave standpoint? And that brings us right back to what's been our two primary interpretations of the S&P and the NASDAQ. This count is applicable across the board when looking at the U.S. indexes. And you end up with one of two possibilities. Possibility number one is that, in fact, that cycle degree third wave did complete at the September 2018 high. We have 3 down into the December low. We have a 3-wave rally back here in orange B. And the move that we are seeing here is simply a motive impulsive 5-wave decline into support here, which would then complete that overall 4th wave correction. When looking at time elapsed in wave 4 compared to time elapsed in wave 2, as corrections of the same degree will often tend towards equality in either duration or magnitude, or sometimes both, you'll end up with a wave 4 that is just over equal to time elapsed there in wave 2. So certainly this count is a little optimistic, and could it unfold? Absolutely. Could we see a plateau in the number of cases? Could we see an acceleration in some sort of a treatment, not necessarily a vaccine, but some of the other alternative treatments they've been discussing? You know, there's just so many variables here that either of these counts could unfold. Both of them have the same near-term implications, and I'm going to get to that now as I bring you full circle. So where, if the markets do continue lower, could this ultimately take us? And Alex actually tweeted out an excellent chart of the S&P, historical chart dating back to the inception in the late 1800s, and identified that 1800 area support, which has been potentially one of our longer term targets. So looking at the alternate of what else could be unfolding here, we're left with what you see here. And essentially what this is an identical count leading up to that September high. This gives us the cycle degree third wave completion actually at the most recent February high, which, taking into consideration the guideline of alternation, that is, we have a flat here in the wave 2 position. Alex, just a heads up, you are live, sir. We've got a flat here in the wave 2 position. So seeing a more directional zigzag in that fourth wave wouldn't be uncalled for. Essentially what this gives us is, once this 5-wave move comes to completion, it would call for a 3-wave move back, which would ultimately be met with yet another 5-wave decline. So notice both of these counts kind of have the same near-term implication, right? We exhaust this 5-wave decline, we find support, we rally back either impulsively in the 5th wave or in a corrective fashion here within orange B. So that's where I stand. I think currently, from an intraday standpoint, we are either moving lower here in 5 or some sort of a B wave of that B wave retracement here in orange B that we're looking at. So do I think that was the cycle degree wave 5 top? No, for multiple reasons, a few of them which we went over here today. So I'm not looking for this to be one of a 5-wave move. If this were going to be one of a 5-wave move, that would call for an extremely significant correction to the downside. What do you guys think?
Alex, Terry, just in there, I'm gonna insert something that's completely off script but related to the longer term wave count.
Yeah, so as you said, I'm going to show you that chart. Am I okay with the sound?
You got better
Hello?
there towards the end. Yeah, you got better towards the end there.
Yeah, that's good.
Do you hear me now?
Yeah.
Yep.
Yes.
Got you now,
Okay.
Alex.
Okay, so I've been looking at this longer term chart, and we have been back and forth, Bennett, with this type of analysis. So definitely, I'm going to be in a camp that we are going to do a prolonged ABC here, or some type of a 3-wave correction back into this. I'm going to show you that chart later, because there is a very strong support from several technical levels at this 1,750 to 1,850. Looking the fundamentals, this picture what you have just shown on the larger time frame definitely suits a correction that will take more time. I think that people which are buying now are generally sucked into a bear market rally, and I think that this is going to be a more prolonged, more drawn out correction that people are supposed it's going to be. So that's my 2 cents.
Very good.
Bennett, toss it to me. You guys ready for something that I think maybe no one in the ElliottWave world is talking about?
I am bringing it to you right now, sir, and the chart is yours.
Okay. So this is the Dow back to DTNIQ brings us back to 1929. Or let's see how far back they go. No, actually, yeah, they do 1928. So what happens if this is not from the 1929, actually it'd be the 30, 31, 32 low is not the end of a 5-wave move. We're not coming into the pretty much the end of American civilization, the end of first world, second world civilization, of our economic growth that we've seen over the last 100 years. What if it's in fact just a minor correction and an otherwise really strong uptrend? So what happens if from the post-29 low, you count 1, 2, 3, there's stagflationary 70s wherever you want to put the wave 4. I've seen Prechter put it in multiple places. Was it a triple 3, just like we're potentially just saw? Is it a triangle, whatever, wherever you want to put it? And then you have the 1980 to the 2000 rally, ABC flat 2 into credit crisis low. And this is just simply 1 and 2 of higher degree 3 that matches up with the 1930 to 2000 rally, 70-year rally. What if this is flat 2? Everything the guys just said is still valid. We're searching for the end of this C wave of 2, but what if it gives birth to 3 of 3? Just throwing it out there. I think Elliott gets a little too pigeonholed with death and destruction. I don't want to say that. Let me walk that back. It gets too much attached to the bearish case. And if I could just take one more second, Bennett, this is an audible. Can I pull up 2 of those slides that I showed at Chart Summit, which, by the way, were you guys there at Chart Summit this weekend? Really nice job by JC and 20 or 30 of the most prominent technical analysts out there. Really, really nice job. This is the presentation I gave that the team did a really nice job helping me set up. And I don't know if you guys have seen this, but I think it's important while we're having that conversation. You know, one of the myths that I think of Elliott is people attach it or associate it with being permanently bearish. And it's couldn't be any further from the truth, because it's just wrong, and it's actually on the diametrically opposed side, which I think ElliottWave is in fact the most permanently bullish form of analysis out there, until some Armageddon-like event happens, and you know that's probably when the comet hits, or the ice age takes over, or you know whatever. So just to set that up and kind of go deeper into it, like, there's definitely a correlation in the population that is walking the face of the earth and total real GDP, our productive capacity, right? And ElliottWave is meant to study exactly this, which is our total our total productive capacity. And the stock market is our report card, right? So the better humans are doing as we transact commerce, the higher our equity and our companies are worth, and higher the equity valuation. And ElliottWave is meant to uncover that back and forth, the interaction between humans on a mass scale as we're transacting business and going through the different socioeconomic and sociological and events that we go through. So the ElliottWave theory at the largest degree of trend is in fact a 5-wave move, which is tracking human civilization and our total productive capacity. We start out way back here, however the origin of time began, boom, there. At some point, we're all going to be in, companies like NVIDIA and AMD and Skyworks and all the chips companies are going to get to the point where maybe the computers and the robots blow up the world, and that would be the end of the wave 5 move, right? So I think while humans are continuing to walk the earth, we are at the largest degree of trend, a 5-wave move. I don't want to really try to foretell the end of the world, because what's the sense? Nobody's going to have any money or anywhere to spend it anyways. So I think it's a pretty good risk reward to turn back to this chart and say, maybe this is about to set up once we get through this stupid pandemic, once we can finally get this thing out of our way. And as Paul Tudor Jones said on CNBC, kick this thing's ass, which would be amazing. Maybe we're going into wave 3 of 3. Maybe we haven't seen the greatest bull market yet in this world. So I don't see a lot of people talking about that. I think there's a lot of doom and gloom, and I think that's something that we need to just kind of put in our back pocket.
Very good. No, I appreciate you sharing that with us. And in fact, that's something that you had looked at even, I think, going back to late last year when we were looking at the overall move off the September 2018 high. You're like, guys, yep, what if this is just a big one too? Like, we've got to be open to possibility.
It's absolutely. I think it's pretty hard to call, to say if this is a 5-wave move, a completed 5-wave move from Dow over here. Sorry, wrong crisis. Yeah, I mean, you have to go back to post 29 or even, yeah, I think it's hard to call the end of an 80-something year rally. What is that? That's 32. So 12 off of, 88-year rally. I think it's really hard to call the end of that. And, I think I've been doing this long enough to know, and so I'm not smart enough to know how to call the end of an 88-year rally. So I think, a lot of times I think Elliott is better used to stick with the trend, which a lot of new people get Elliott and they look for the end of every 5-wave move and they say, sell it, short it. I mean, look, I understand it's rooted on, 5-wave moves. If you get in front of a 60-minute chart, and that's why a lot of people, I think that's why Elliott catches a bad rap, because people are trying to short the end of a 5-wave move. But you got to keep in mind that at the largest degree of trend, there's a massive 5-wave move that's tracking human progression. So do what you can to use Elliott for good, which is trading with the trend.
Absolutely.
Sorry, Ben, I'm done.
No, I love it. And, I think one would be foolish to try to call the end of, an 80-plus year rally in the market. So I think that was an excellent point. All right, guys, what's the comments looking like? Any feedback here? Let's just get our triple back. Terry, you want to bring us up to speed with some sector analysis before we transition into crypto and the Forex world and our macro overview?
Sorry, I'll shut up after this.
No, you're good.
It's April 1st. He goes, Todd alternate account. It's April 1st.
That's where the chart came from. No, I'm just kidding. I love it.
Bennett called it. April Fool's Day is canceled.
All right, Terry,
All right,
the
guys.
screen is yours, sir. Coming right at you.
Okay, so this week is only 2 days long in terms of my data here. I only have end of the day data, but first 2 days of this week, we can see that we've got healthcare and communications and even energy up here in the lead, taking legs. I've got financials, real estate, and utilities taking a bit of a dip first 2 days. Now, I did see futures, looking at the futures quotes here in a minute. It looks like they're down about 3%. So I think we're going to get a little bit of a roller coaster ride. Obviously, the volatility is going to continue through today. Let's jump over and take a look at our weekly sector rotation. One of the things to notice is that, with the exception of energy being so far down here in the lagging quadrant, all other 10 of the sectors actually are floating inside this 2 standard deviation filter. And that what has happened is this 2 standard deviation move is growing as volatility in the market is growing. This circle will grow, right? So if I animate that, you can see. Look how large
That's
that
really
grows.
interesting, Terry.
So the movement.
That's really
Go ahead, Todd.
No, sorry, I don't want to interrupt. That's very interesting. That's such a good point. Correlation grows as volatility.
So this the movement of that circle or ellipse, right? It is representative of the growth and volatility, right? So look at the size of the circle all the way back to like May of last year, right? So just look at the relative size, and you can see all the sectors moving in and out, in and out. A little bit of volatility growth here around December, and then back to normal, and then bam, there it is, right? So 1st of March, look how big that. So really, everything is sitting inside here.
That's a cool visual.
That's a great way to. Wow, that's amazing.
So anyway, so now, like I said, everything is kind of gray shaded because it's sitting inside our filter, which means, everything is moving relative to the S&P. The S&P is here in the center of this, right? We've got staples, utilities, healthcare, technology, and communications just eking out a little bit here, all up in our leading quadrant. And the weekly rotation will show you that you see a little bit of a hook going on here in utilities. Utilities beginning to lose a little bit of momentum. Now, stuff that's furthest to the right is going to have the highest relative strength ratio, and obviously technology is still hanging in there. losing a bit of momentum. That's the vertical axis here. Look at healthcare. Healthcare, obviously, healthcare to the rescue for the world, right? So here's our chart of the XLV. This is a daily price chart, and we made this dip. So depending upon whether we call the top here is Bennett, is this a 1, 2, 3, 4? Maybe the top's here, and this is 1, 2, 3, 4, or is it ABC? We're going to have to take a look in our motive wave and Elliott waves. But we've made nearly a 50% retracement, I believe, here in healthcare. I have my little fib retracement tool here. Let me draw that on there real quick and see what we see. Yeah, a little bit between 38 and 50%. I still like technology. I like anything that's going to be sitting out here with high relative strength. We've got to take a look and see what's going on inside healthcare. So let's jump into healthcare, and we'll pull this chart up. Well, this chart is the top 20 XLV stocks relative to the S&P itself, right? So you can see Gilead way out in the lead, Eli Lilly also. The same chart, if I compare it to the XLV itself, gives you the leaders of the leader, right? So if we say XLV is one of our leaders, what are the stocks that are really leading us? Regeneron has got a much higher relative strength than Gilead. Look at this. Look at this guy here. I really like Regeneron. They must be on to something, because their stock right now is trading above the 20-day moving average. Has been running above the 50-day handle. Where was the drawdown in Regeneron? Where was the bear market run? It went from 500 to 400. Yeah, it lost 20%. But look at this chart, guys. That's huge, right? I like them. I like Elliott. Let's jump over into the tech sector here and do the same kind of thing, right? So if we look at the tech sector, so because tech sector is the clear leader of all the sectors, it's already pushed too far to the right, or not too far, but very far to the right in terms of the S&P. This one is relative to the S&P. Nvidia's making a nice push even higher as we speak. So the chip stocks, I want to point something out here, because we had a couple of months ago we were showing you Apple and Nvidia were tracing together, and they were pushing down in momentum rapidly, although relative strength was holding on. So keep your eye on Apple and Nvidia and watch the separation that occurs. So the separation occurs here. Nvidia tried to push into the weakening quadrant. And then it reversed and started pushing higher again sometime around the end of February. And then Apple is just continuing to weaken. So now you can see complete divergence in these two. Nvidia is going its own way. Apple is continuing to push further south. Nvidia is pushing higher. I also have been pointing out Adobe and Microsoft. Somebody mentioned Intuit, PayPal. So PayPal did jump over here into our leading quadrant. It is starting to lose a bit of momentum, right? So, but these guys here are going to be the leaders. When we clear resistance and settle out the final push lower in this consolidation that we're calling for, we're going to be looking at the leaders to be the ones that are going to first jump out of their base and set some new highs. Now, on the opposite side of things, here is financials, right? So,
Yeah.
So I got like one stock maybe doing pretty good, and that's Progressive. And I think Progressive is an auto insurer mostly. Maybe lower automotive driving means they're just collecting premiums and there's fewer accidents, maybe.
Yep.
Less exposure. Yep.
Yeah, but the majority of the stocks in the XLF, they are all down here in this lagging quadrant, right? So it's not the time right now to go bottom fishing for any of these guys. We need to wait until we see a little bit sharper hooks, and we want to get these guys to start to show who's going to be coming back around the horn. But my money's going to be on the sidelines with in terms of financials. if we look at the stocks with in terms of the financials relative to the XLF itself is not doing well. So that doesn't mean go buy these stocks here. But this would be, if we were in that point, these would be the stocks that I would want to think about putting into a longer term portfolio once we get out of this situation here. Todd mentioned Amazon. Amazon here is consumer discretionary. This is the go away chart there. This is relative to the XLY. Who is leading? Well, how much percent is Amazon of the XLY, Todd? It's the majority. What is it? 20%?
19%.
Yeah, it's about 20% of the XLY, right? So it is huge in terms of the market cap, and it is certainly also the one that's leading. So therefore, I think you're seeing pretty good. It's pulling Amazon all of this negativity higher, right? So Amazon continues to push higher. Dollar General's not doing too bad, right? But here's Home Depot, McDonald's. They're kind of stuck in the middle. Most of these restaurant chains are, and the entertainment stuff, Marriott and all of those, they're headed south here. So, what else is that? That's about it. Staples has been performing well recently. This is XLP top 20 versus the XLP. So who are the leaders? It's kind of hard to, there's not really anyone sticking way out here to the right, but Costco, Colgate, General Mills, even Walmart, all of these guys I think are going to turn excellent earnings even during this coronavirus downturn. There's certain industries that are still up and running strong to keep the rest of us fed, and I can't say in toilet paper because I haven't seen it at Walmart lately, but
I love it.
So
well, very good.
Let me swing it back over to you guys. You got any questions, anything, Todd, you want me to hit up real quick? I'll be happy to pop that in there for you.
No, I'm good. I want to be sure we get Alex in. I want to see what's going on the macro front.
Very good, much appreciated, Terry. Yeah, I wanted to see tech, so I'm glad you went through that. Gives me a good idea what you're seeing there, and what a great visual that you had there earlier of that expansion and volatility. So let's go ahead and bring in Mr. Alex, sir. Are you ready?
Yeah.
All right, let's go ahead and make him presenter. If I can see across to the other monitor. Terry, did you make him presenter? Thank you, sir.
I'm born ready.
You were born ready. I love it.
How do you say that in movies? I'm born ready.
I stay ready so I don't have to get ready.
Yeah. Okay, guys. So first, I will show you this S&P picture.
Okay, we've got your YouTube window. Just a heads up.
Oh, sorry.
No worries.
There must be a wrong. Shares. Okay, so now you have the chart window.
Yep, there you are, sir.
Okay, cool. Okay, so this is my long-term. You already showed this chart, but I just want to go through it through several technical perspectives. Also taking in consideration the Todd's wave count, which should not be disregarded.
Absolutely.
Why we should think that. This is actually the close to the end. Maybe we just correct and we go further on the upside. That's quite possible. And this is exactly what I see here on this chart. I don't see the exact labeling. Even if you erase this labeling completely, you will see that here we have almost 100-year trend line. Okay, so this is not like we are drawing trend line on a 1 hour, 2 hour, daily, weekly. This is 100-year trend line. So it goes from, and it's ElliottWave trend line. So if you want to do a correct ElliottWave trend line, you need to connect the beginnings of the wave 2 and wave 1, and you project it and leave it as it is. So if you do that here, you will get rejection here, 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 and I think next one is here. So if this comes to 100-year trend line give up, I will be scared. Okay, but if you also can see with this trend line, the RSI lows on monthly level hold almost perfectly every of these lows. Okay,
Nice.
so we are not yet there from this perspective. Okay, so also what you have there is this support 200 moving average on a monthly level. So all of these levels coincide with the 100-year trend line, 200 moving average on monthly, and the RSI around possibly 2030. Okay,
And
so there is
Alex, that
yeah.
200 month, sorry, that 200 month is at 1689. Is that correct?
Yeah, that's
Yeah,
you,
exactly. Yeah. So, but
Okay.
if you,
Okay, wow.
if you, I mean, I'm just trying over these support levels 1.750, 1.850 kind of encompass all of this what I'm seeing here. So in a smaller time frame, there is a previous wave 4 here on our Elliott wave count. So either this is a 1-2 and even towards wave 1 or this is a wave 2, we should reach these support levels. In any of these cases, either the bullish, we go skyrocketed, we go to 5,000, 10,000, whatever, or short-term support levels are easily seen to be here because there is a so big confluence of levels, which are kind of 100-year strong levels that I don't think this will give up. Okay, I'm just monitoring this through all of these several indicators and the Elliott wave perspective and trying to find a zone of a perfect confluence. And I think this is the zone of a perfect confluence for now. If we break through that decisively, I will be worried. Next support is around 6,666 in a previous area of the wave 4 from the Elliott wave perspective. But I don't think this will crack. Okay, so I expect a year or so, as Bennett says, at least either in a towards wave 2 and we go bullish, or this is a wave 4. Anyhow, this is a buy level for me. Okay. So let's go in a little bit of macro, and I will tell you I was surprised by the Fed because Fed actually didn't manage to react in 2008 to dampen the dollar index liquidity at all. So what we have in 2008, I will show you this larger time frame. Just to erase this, this is just some working version. I have it prepared, but I think the IQ is with you, Todd. So I will just drop this
Do you
line.
need it? Do you want me to log out?
No. It's
Do you want
fine.
me
It's fine. Okay. So 2008, we have seen the dollar moving higher rapidly. Why? Because the offshore dollar markets, all the EEM countries which are growing by the GDP, actually holds the U.S. Treasury as in their portfolio. And when they need dollars, they sell these U.S. treasuries to gain the necessary dollars. And this provokes an amazing move in runs of dollar on the upside. Surprisingly, Fed this time very quickly supplied a very two basic lines for addressing this question. So what they did, they did 14 country swap lines and provided the necessary dollar liquidity to major holders of the US government bonds in the world. And secondly, they opened another window 2 days ago, a so-called FEMA, a repo facility, which allows you to bypass the market and get also the necessary funding from Fed as well. So if you want to read what is the FEMA repo facility, I suggest you go on the internet. And you also have this on the Fed side. So I think actually the current need for dollars was addressed by the Fed very fastly, much more faster we have seen in previous crises. And I will show you also one chart which shows how much liquidity actually Fed gave to the countries up to now. It might be a little bit blurred, but this is the swap lines. It's equals now around $8.2 trillion. Okay, so up to now, this is an old chart. I think it's a last week chart. I need to update this, but up to now, Fed approved swap lines in amount of 8 trillion, and I think there is a demand roughly between 12 to 20 trillion. But we don't know how much of the reserves these countries will use, but they open another window. So I'm not going to bet that dollar it's going to go much higher from here. Okay. So with all of these repo facilities, I'm going to take a stance, taking in a situation, because that was the only unknown thing in a current dollar equation, how much of the dollar is necessary on the front outside of the USA. We have this almost covered, at least 80% with the Fed. Rates are zero in euro or in other currencies, so over there dollar doesn't have any advantages. People are actually selling bonds in Germany and in US and go back to cash. So we are not seeing treasuries skyrocketing on the upside. So I'm going to be dollar neutral to lower. Okay, I'm not going to be a dollar bull until we cross these levels here around 103.20. So even I want to position my clients if I see 5 waves up on euro on the short side on dollar, because I think the only invariable factor here is actually which region of the world it's going to heal first. Okay, so being that unfortunately that United States is just entering the weeks that it's going to be the peak, as the Europe is already passing one, China already passed one, South Korea already passed one. I think that the investors, if this dollar liquidity is sufficient, we will actually decide to play a little bit on inflation hedge on the upside. So I think euro might be stronger from here. That's my take as regards from euro. I'm waiting from the signs for that. And on a smaller time frame, we have something which resembles a 5-wave move on the upside. I'm waiting a final confirmation that I can see a 1-2 up in 3, and this is very discernible and nice. And I'm waiting one more push on the upside to this 112 zone, and then on this pullback, I'm going to be long euro for this 120, 125 levels on the euro dollar macro side. Okay, so dollar yen actually doesn't budge anywhere. As you know, Todd, back in old times, 2008, when the S&P fell down, dollar yen will actually be around 80, 85. So now we didn't saw that. So actually, I think dollar yen is actually, it's going to consolidate even more until the S&P find these lows that we talked about, and then it will skyrocket it on the upside. So I'm going to stay neutral on dollar yen, and I'm going to wait this consolidation to finish, because I don't see any bearish or bullish wave counts here yet. Okay, so this is dollar yen proved enough of the resilience during the move down in the S&P that I cannot really be on the short side on dollar yen. Okay, maybe in the second round, but now not yet. I think we're going to correct a bit until the 5th wave is done. We're going to go up in a correction, and then the D wave with the next fall. That's my take, and that's my count that I'm follow. So I think ABC pullback E wave, we find the lows in stocks, dollar yen find the lows and finish of this triangle, and we are going higher. That's my working scenario for dollar yen at this moment.
Really smart, Alex. I really do. I mean, I think your point is such a good one. We had pretty much the same volatility level in the equities 08.
Even
and
worse.
The currency market
even worse.
Was and the current FX market was a completely different animal this time. Flight to safety in 08, even though the U.S. started the housing crisis and it spread much like this virus to the rest of the world. We didn't see the flight to safety here in the U.S. like we did in 08. And if the dollar couldn't rally on this, then I think you're spot on. I think that's a really good point.
Yeah, that's regards to the dollar. But as we look dollar yen, if you remember 2008, dollar yen was actually moving with the S&P down like hell. And the rest of the yen pairs, from these pairs, you can see only Aussie yen going down. Even euro yen didn't budge, which is amazing. I mean, with such a moves down in assets in United States, which is strongly correlated with all of the yen pairs to safety, euro yen and dollar yen moved like, I don't know, 1.5%, 2%. and then even goes higher. So I
It's
think that is
unbelievable.
also connected. Yeah, it's unbelievable, and actually, I think this will be the outcome of this. We consolidate until 2021 January, and then we go higher with the S&P. So I'm going to avoid this pair for trading as well. Dollar CAD and oil pairs are definitely very interesting stuff, and I can show you some of the very interesting charts there if we have time. So actually, dollar CAD is moving higher. I'm waiting here a pullback to put our members on the long side, and I think this is very clear from the ElliottWave perspective. There is a wave 1, 2 down, up in 3, nice 3 waves up. I'm waiting just this consolidation a little bit more to unfold, and I'm going to be long against against these highs here for another push up in dollar CAD. We also can see that in other dollar-related, oil-related currencies, dollar NOK broke higher. I think we are not done here. I remodeled my wave count for a dollar NOK much higher. So I don't think this is the end in oil, and this corresponds very well to Bennett's and trading analysis work on what is going to happen with oil. Also, the other chart shows a very interesting thing. This is a dollar ruble. Okay. Let me just see if this is here or I have it somewhere there. I have to leave it for next time because ruble won't come up here. I will just show you, for example, one of the dollar ZAR. So we are out of a triangle here. So dollar on some front goes up with the countries linked with commodities, and with the other countries which are not linked to the commodities actually is neutral to lower. So what is this telling us? It's telling us that in either way, when we see the S&P goes higher, we go sell dollar, buy risky assets, or and as well now we can also play a sell dollar. So from two perspectives, dollar is double sell for me now. Okay.
Alex,
So on the crypto space, yeah.
Sorry. So how does that
Okay.
tie in exactly to gold, though? What do you have it? Do you want to go into that?
Yeah, sure. Okay, so as you know, our wave count on gold was twofold. So the gold is a big question mark from me from two standpoints. Okay, so are these big stimulus? It's gonna provoke inflation into the system. Okay, so that's the first question. We are far away for seeing that. And secondly, what if this crisis go a bit longer and sovereign countries starts to sell gold to obtain the necessary financing for their own, because now governments are actually your last lenders. It's not anymore the banks. The governments are actually financing the whole countries for the next few months. Do you agree?
Yes, I
To some
fully
extent.
agree with that.
Yeah. So I
We're
mean,
waiting
I
for our
don't know.
stimulus checks in the mail.
I don't know if you saw this headline yesterday, but Russia starts selling their gold not from a central bank, but from the special gold fund to finance the devaluation of the ruble and the oil war with Saudis. Okay, so Russia
Wow.
was the first one to sell its gold, and if we are staying this crisis for the next several months, I don't think we have in a much more countries already alleviated with debt a much of a space on a fiscal side. So monetary side will probably, we did all the stimulus, maybe there is a few more shots. And what is the next move? You're going to sell gold. Okay, on the open market, who buys it, and then you finance your budget deficit until the crisis is over. So my question on gold is, as you can see, we are here in a very, very difficult position. We came exactly, and this is what is very, very tricky. This wave count perfectly. We held 786. Okay, let's short it. We go down. But if you look the bullish wave count, we might do just ABC, inflationary scenario. Nobody sells gold. We go down in the next few, let's say, months or two, and then on inflationary scenario, we shoot up back to 2,300. So I think gold is really an asset to be watched. I don't think it's to be traded now, because if I see a few more countries start to sell gold, I will sell it, because then we probably going to see a next round of selling from the central bank reserves, and this might provoke a huge move down despite all of. But another point, Todd, we have S&P down. We have a COVID crisis on unprecedented level. Where is gold? Sideways.
Yeah, it's just like the
Something
dollar.
is wrong. Something is wrong there. Okay, we are trading sideways with the
Yeah,
crisis,
I
which
know.
might be the crisis of the past 3 centuries. Eventually, in the worst case
Yeah,
scenario,
it's unbelievable.
and we are
I
trading
agree.
sideways. I
I
mean,
agree. I know, it's unbelievable.
yeah, yeah. As with the dollar, something is wrong here because I want to see a move up above this 1800, but we didn't see that. We see attempts, but a failed attempts. Okay,
Yep.
so gold is a wait for me, and very very big a wait and a question mark until we broke these trading ranges on the upside or on the downside. Okay, I will touch base on cryptos just a second. Cryptos, nothing new, guys. We are short. We have been having a few trades, small ones, nothing much. We are short for a possible move down for this wave 5. 3 scenarios still valid here. Okay, one scenario is this is a big triangle. We go A, B, C, D, E, and we go up as something similar as dollar yen. Second scenario, this is wave 1. We go down in 2 and we go up in a wave 3, 4, and 5 or WXY. My take is we're going to go WXY and we buy Bitcoin around 2,000, 2,500 when we see the lows of the S&P. If you go on a 1-minute chart or a 15-minute chart, Todd, on the S&P and Bitcoin, they're in perfect correlation. So
Yeah,
what
that's
is
amazing.
what is amazing? What is amazing is that, as Terry says, we actually can back down on the kind of thesis that Bitcoin is a safe haven. It's not a safe haven. Everybody was dumping Bitcoin when the stocks was moving lower, you know. So we can just actually see that when there is a crisis, nobody is going to search for cryptos, and I think that this thesis is going to stay for a while on the market until we stabilize. I'm short on purpose on a wave count and on that thesis, because in these times when you need money, especially from the retail sides, are you going to buy cryptos? Yes, maybe you're going to buy some small increments, but are you going to go big when you have a COVID crisis, when you need food, shelter, whatever? Of course not. Who's going to buy crypto? You know, for now. I'm just saying for now. Whales are not there. Funds are actually, because of the VAR and as you know, risk of value in their portfolios, are dumping the peripherals, which you can see in different space of EEM bonds and cryptos as well. So I don't think there is a still buyers there. If it's going to go up, it's just going to correct, nothing more. That's my point. And technically, it's very visible. We are still sideways.
Very good,
Okay.
sir. Much appreciated.
Well said.
Guys, we got, what, 10 minutes here to the open? I mean, 10 minutes till our premier member webinar. So sorry for going so long. We've been running till, you know, gosh, 9:45, 9:50 Eastern has kind of become the norm here. So do apologize, but I appreciate you guys sticking with us. And if you enjoy the content, be sure to give us a thumbs up, subscribe below, and check out our website, tradinganalysis.com, stock, options, Forex, crypto services. In fact, I'll go ahead and drop a link in the chat for anybody who is interested. And gentlemen, thanks for tuning in. Any parting words? Any last thoughts here?
No, I thought that was really well done, guys. A lot of smart comments from the team. I'm very much in agreement with Alex. And I saw some comments coming back that they saw when I showed that super long-term count. If this is just a wave 2 expanded flat correction, the downside implications are the same. You know, if we fail here and we are starting to roll over, I couldn't agree with Alex anymore. That 100-year trend line was interesting. The 200-month moving average. I'm looking at the little daily, weekly chart of this expanded flat. You know, if we fail up here, 25, 2600, not much keeping us, I think, above 2,000, and I think that's going to be the value zone. So I don't know. I thought that was really well done, guys.
Appreciate it. Thank you, Todd, Terry,
Thank
Alex.
you, boss.
Good perspective. Yep.
Yep. Stay safe, guys.
Be safe, stay healthy, wash your hands, and
Yeah, wash
This
your
thing is not a
hands.
joke.
we'll catch.
Click the little thumbs up window on the YouTube window to let Google know that you're enjoying the content. And after you touch that hand, wash your hands yourself. That's a terrible joke. You'll get
It's
it.
a good one.
All right, guys, we'll let you go. Thanks for tuning in, and we'll catch you next week. Take care.
See
you
you
guys.
guys. All the best.
Take care.
You bet.